Good morning and welcome to 5 Before the Bell, TheStreet.com's daily market preview and global market update right here from the Central London studios of Core TV. I'm Martin Bakardax. I am the London Bureau Chief here at TheStreet.com. I do beg your pardon. I'm going to take you through those 5 things you need to know before the bell. Clearly, my voice is still in holiday mode, but my energy level is up, and it's a fascinating day for global stocks. As you can see right now, we're looking at some of the biggest declines for European markets of the year so far today. We're off a little bit less than 1% across the board. Actually, I should say a little bit more, but it was much higher earlier in the session. Investors are definitely in a risk-off mood. Of course, the firing of a missile last night by North Korea, which launched over the Japanese island of Hokkaido and landed only 1,200 kilometers from the Japanese coast, was the big part of the reason that investors are so risk-averse today. It's the first time that a North Korean missile, in point of fact, has gone over the flight path in Japan since 2009, and it certainly represents a real and significant escalation in the military tensions in and around the region. Now, Japanese Prime Minister Shinzo Abe said that he spoke with U.S. President Donald Trump overnight, and they are shoulder to shoulder with respect to their agreement to intensify some of the political tensions with North Korea in order to come to a solution that does not involve military feet or boots on the ground. And we can all hope that that is exactly what comes out of this, but nonetheless, the fact that we are seeing the intensification of this situation at the same time that the U.S. is picking its way through the deadly devastation of Hurricane Harvey is significant enough, again, for investors to pull back in the way that they have. As I mentioned, down a little bit more than 1% across the board, and largely, if you look at it from the Stocks Europe 600 perspective, it's probably going to be this biggest single-day decline of the year when all is said and done. However, we are seeing U.S. futures stabilizing just a little bit, so perhaps we'll see a bit of a turnaround in the second half of European trading. Okay, we're going to move on and talk a little bit about Amazon, because this is the first time that European shares, particularly those in the United Kingdom, have had a chance to have a full whack at the implications of Amazon's decision to cut prices at its Whole Foods unit as of yesterday. You'll remember, of course, that Amazon purchased Whole Foods back in June of this year for $13.7 billion, and it has, of course, upset the apple cart in the the U.S. retail space, but it's had an implication for the U.K. market as well, because it's a further piece of evidence in the ongoing price war, particularly in food, but in broader retail as well. So we've seen some of the biggest UK retail stocks, Tesco for one, Morrison's Supermarket for another, falling around 2% across the board. The biggest decliner in Europe over the past couple of days in the retail space has been a Dutch firm called Ahold. You may not recognize the name, but Americans will recognize the Stop and Shop brand that it operates under in the United States, and that is going to come under increasing pressure, not only a result of the decision to cut the prices at Whole Foods by as much as a third and up to 43% on some items, according to reports around the United States, but also given the fact that Aldi and Lidl, which are 2 German discount retailers, are planning deeper expansions into the United States. Now, this is, of course, going to have dimensions that are very significant in terms of change in the U.S. retail space, and we're seeing them here in the UK as well. But I'm also fascinated at the way that these are going to impact inflation and inflation calculations, because what I think is always underappreciated from the economic perspective is the way that online retailing is putting downward and consistent price pressure into real-life expenses. And as a result, the way that inflation is measured may not be an accurate reflection of the way that inflation plays itself out in the real economy. So I think that that will ultimately have implications for the way that we look at the Federal Reserve and the way that we anticipate their rate changes in the months and years ahead. And of course, maybe even more significantly, the way that we think about inflation writ large, because everything that we have talked about here at TheStreet.com over the past 5 or 6 months has been anti-inflationary. You're talking about things like automation in the automobile sector. You're talking about robots and artificial intelligence. You're talking about Amazon's purchase of Whole Foods and the price cuts that have come. You're talking about the ways in which we are changing our energy consumption and, of course, the consistent declines in crude oil prices. All of these, if not disinflationary, are deflationary. And that, of course, is going to change the way that we calculate consumer price rises, and as a result, it changes the way that we think about central bank policy. So while on face this seems like a retail story, and certainly it's being played out that way in stock markets, it's actually a broader consumer story and indeed a broader macroeconomic story, and it's one that I'm certainly fascinated by and one that we're going to have to pay attention to in the months ahead. Google is another story that we have to pay attention to today and in the months ahead as well. Today marks the 60-day deadline that the EU had placed on Google to reply to its record $2.7 billion fine that it levied earlier this year as a result of its allegation that Google favors its own search results over those of rivals. Now, interestingly, normally in an antitrust ruling, you'll have certain prescriptions that the regulator puts upon the accused company. It says you have to do this in order to come into line to what we feel is fair practice. In this case, the EU basically put that onus on Google and said, you guys have to come back to us and tell us what you are doing to make the competitive landscape more equitable. So therefore, the deadline, as a result, was today. So Google is going to have to convince the EU that its rivals have made significant inroads and that the landscape for search results is fair, or at least fair enough for the EU to be satisfied. If the EU is not satisfied, it could levy further fines as of the 28th of September in this specific instance. Now, again, from a cash perspective, this is probably not significant for Google, given the amount of money that it sits on and the power of its quarterly results, even given the fact that they were lower than expected in the last quarter as a result of booking this $2.7 billion fine. But what I'm interested in is the way that this could have implications for different probes that the EU is now either involved in or thinking about becoming involved in with respect to Alphabet and Google's operations. Probably the most significant is that with respect to Android software and the bundling of the Google Play App Store inside it. If they're not allowed to do that, that opens the door for rivals. Now, of course, the EU is said to be looking into that. Haven't made anything official just yet, but it is coming up into the window relatively soon, and it mirrors the launch, of course, of the iPhone Anniversary Edition, which is coming, according to reports, in the next few weeks. They're also looking at AdSense, with respect to the Alphabet business operations, and also possibly looking at the travel and map services as well. You have to remember, too, that Intel, which was fined an earlier record $1 billion by the European Commission back in 2009, is only going to get a final ruling on that next week. So we're talking about nearly 10 years of legal ramifications for Intel. We, of course, know that Microsoft has been back and forth with the EU Commission over several occasions with respect to allegations of unfair practices there. So the fact that Google is only into the 60th day of this means it's not going away. And, of course, the fact that the onus is on Google to prove that it's playing fair rather than the other way around probably means this is going to hang over the company as a headline risk going forward. Shares are called down about 0.9% right now, but I do believe the implications are far more to the longer term than they are to the immediate. Okay, we're going to have to move to the biggest story and probably the most depressing of the bunch today, and that, of course, is the devastation that we're seeing in the Houston area as a result of Hurricane Harvey. It's been downgraded to a tropical storm, as we know, and that does result in a little bit of less wind speed and, thankfully, a little bit of relief for the 6.8 million Houston residents. But nonetheless, the devastation is stark indeed, and it is really troubling to watch. We're looking at flood levels that are unprecedented in and around the region, and, of course, we've seen damage in the state of Louisiana as well, which is still, in some ways, picking through the debris of Hurricane Katrina, which goes all the way back to 2005. And the symmetry between the two catastrophic events is really quite sad indeed, and certainly in some ways even heartwarming when you consider the fact of the support that the two cities of New Orleans and Houston have offered one another in and amongst these terrible events. It does speak to a certain brotherhood of the region and maybe a welcome sign of brotherhood amongst some of the divisions that we're seeing in American politics at the moment. Now, maybe Mr. President Donald Trump will speak to some of those divisions today when he visits the region. He's also meant to be visiting Louisiana later in the week. But I think from the economic perspective, we have to come through to the costs of the hurricane and the tropical storm that followed and the 70 inches of rain that are now deluged around the region. At the moment, we're thinking somewhere in the range of between 30 and 100 billion US dollars. That's the early tally, according to the reinsurance industry, or at least some estimates from it. But we won't really know until the days and weeks ahead, and we probably will surpass the 118 billion US dollar cost that, of course, was racked by Katrina in 2005. The human cost has gratefully been very low indeed, and I don't mean to minimize the deaths of the 8 people that have been reported so far, but when you consider the damage that we are seeing on our screens pretty much on a daily basis over the last 2 or 3 days. It is indeed, it must be said that the death toll has been managed to the best degree that it could be possible. 30,000 people, however, have been displaced, and about 450,000, according to federal authorities, are going to require government assistance. So at the moment, the reinsurance sector, from the market's perspective, has actually weathered it relatively well. European stocks have been on the back foot, Munich Re, Swiss Re, Hanover Re, and some others, because of the fact that we have this large window of anticipated costs. The upside, if there is one, and I hate talking about market upside in a story that's as devastating from a human perspective as this, is that the insurance companies are probably going to be able to raise premiums going forward as a result of this, and they, of course, have been in a low premium environment for a number of years right now. But again, that does seem a little bit callous when you're still looking at the human devastation that is wreaking around the region right now, and of course is going to be continuing so in the coming days. We're going to move on to Wall Street now because we're looking at about 100 points to the downside for the Dow Jones Industrial Average, looking at about 43 points to the downside for the NASDAQ. That's about 0.7%, and about 14 to 15 points on the S&P 500. We're certainly going to look at oil prices in the market today. They've been a little changed from last night, and actually considering the fact that about 17% of U.S. refining capacity has come offline as a result of Hurricane Harvey. The curious thing is that the path of the storm didn't really affect the drilling installments in and around the Gulf region as much as you might expect. So analysts think there might actually be a build in crude inventories that will offset some of the weakening demand. So as a result, prices are a little bit flat at the moment, and I think from what we have been reading, the suggestion is they could fall in the days and weeks ahead as a result of this rise in crude inventories. We're also going to look at the tech space as well, because they are a little bit to the downside today, and I'm curious as to exactly why. The Google story is part of the reason, I think, as well, but there is some decent numbers in and around the Apple space, of course, with Tim Cook being awarded one of the biggest corporate pay rises in that company's history, according to an SEC filing that came online last night. Now, interesting when you consider that, we were just looking at some very simple numbers with respect to Tim Cook's tenure as CEO after Steve Jobs resigned in 2011. And actually, the stock has risen about 195% over that time, compared to about 100% rise for the S&P 500. So an excellent outperformance from Mr. Cook. And he's actually done reasonably well, even though the company has come under some criticism for a lack of new products and maybe some of the whiz-bang achievements that Mr. Jobs was able to accumulate over the number of years that he ran the company. It has to be said, Mr. Cook's tenure has been solid and steady, and the stock has outperformed. So that's one that you might take a look at the opening bell. And in point of fact, I'm going to give you an indication of where that is trading at the moment, and it is about 0.7% to the downside at about 160.40 per share is the anticipated open for the Apple shares. Okay, that's it for me here in central London and 5 before the bell. You can check out all these stories and a whole lot more on thestreet.com and dig in even deeper if you go to realmoney.com and check out what our Jim Cramer is saying about Harvey, about the tech sector, about oil, and just about everything else. So thanks for joining us, and we'll see you again tomorrow.